AMC, $100,000 per share. This has been a topic of discussion for quite some time. People will say, not sell to 100,000, baby, to the moon, to freaking Pluto, to this and that. And 100,000 has been hypothesized, and I've seen theory videos, and I've seen math behind it, and I've seen insurance policies and who would pay for it and this and that. And I've always stayed quiet on the topic for one reason and one reason only, and I'm being honest to God here, is because I was scared. I was scared to discuss this topic. I did not want to have the backlash that I think is going to come discussing this, but I am going to discuss it today nonetheless, because I think it's important, and I think there are people out there who need to sort of do the math, right? And I'm going to walk you through the math. So, guys, welcome to Trey's Trades, where we can talk fast and so don't skip class. I think I'm preface by saying that I'm not a financial advisor or expert, so take what I say with a grain of salt. Let's get into it. Today, I have a claim. Right? And there's good news in this. I want you to know that, right? I'm going to give you a silver lining at the end of this video, but we do need to have a talk about realistic expectation and money and math behind how something like this would be possible. I'm going to make a claim. $100,000 per share is statistically and mathematically impossible. Now, I know that right off the bat, I'm probably going to lose some of you, and that's okay. If you want to unsub to the channel, please do. If you'd like to sub to the channel, please do. I'm not here to tell you what to do. I'm not here to tell you what to think of me. What I am here to do is tell you what I personally believe makes sense because of math. I'll give you some reasons why. This is the agenda. I've got a list of problems, a list of counter arguments against the problems, right? Things that I've seen people state towards me in terms of, hey, this is why this would be possible. And we're going to make arguments both ways. All right. Then I'm going to give you the resolution, which is down here below. So to start off with, there may be people out there who don't know what market capitalization is. Market cap is the value of a company that's traded on the stock market, and you receive this value, which is actually how much the company is worth, by taking the total number of shares and multiplying it by the share price. So if you were to have a X stock, the ticker is X, and it has a 100 share float, and you have the price at about $100, that would mean that you have a market cap of $10,000 for that stock, right? That company would be worth $10,000. This is kind of how this works. Examples of market capitalization would include, but are not limited to, Microsoft. If you take the free float, which is 7.47 billion shares, and multiply it by the price, you get $2.02 trillion. If you were to take Apple, $145 stock, there's a circulation of 16 billion shares, you get a market cap of $2.35 billion. If you were to take Tesla, $703 stock, total free float of 857 million shares, gives you a $603 billion market capitalization. These are just examples of how much these companies are worth, and is going to be applicable as we move forward through the video, so bear with me. The entire net worth, so to speak, market capitalization of all stocks across the entire U.S. stock market, according to this company, Siblis Research, as of March 31st, 2021, which is probably likely lower at this point as we are in a bear market, was $49.1 trillion. Three zeros, 49. $49.1 trillion is the whole market capitalization of all stocks in the stock market, excluding derivatives. I will talk about this later, but the derivatives market does make up approximately $1 quadrillion. This comes essentially from leverage and margin. You can see the leverage behind, for example, futures or options. Or there's lots of back end ways to sort of make money out of nothingness, and that's excluded from this number. Some of this could be margin, some of this could be debt, some of this could be rehypothecation of a loan. There's a lot of ways that you can make that $49 trillion number happen, especially when you consider the fact that all money in circulation right now, currency in circulation within the U.S., comes out to about $22 trillion. If we're to zoom in here, you will see that we were at $20 trillion as of about 2021, and now we are hovering up very close to $24 trillion worth of circulation. We printed a lot of money, right? Now that we have understood sort of the premise behind how much money is in the U.S. stock market, I want to show you a visualization. I've got three examples here, right? This is a visualization of AMC at the present free float that exists. The free float, in case you didn't know, comes out to about 515 million shares. I'm going to pull this up. 515 million shares right here is the free float of the stock, and that is not including any sort of shares that can be rehypothecated, naked short sold, or synthetic. And I do believe there are synthetic shares within this stock. I think that's very likely considering the math behind it. I'm not taking away from that in the least bit. I think that you take 90% of the company being owned by retail and 35% being owned by institutions, maybe even slightly more than that. You've got some of these shares that are being rehypothecated and lent out and borrowed and this and that. You got a whole jangle McFuck gangbang of shares that likely shouldn't be circulating in the market. Three examples. Normal, plus 100 million shares of synthetics. This is a hypothesis, right? This is essentially an example of what could be. Or 2 times the float in synthetics, meaning you've got 515 million shares of synthetics circulating in the market. Now, using this simple math that we used before, I'm going to show you what market caps you could see, right? At $100 a share, you would have a market cap on AMC of $51.5 billion. Seems very likely. I could see this happening. I genuinely could. If you had $1,000 a share, you could have a market cap of $515 billion. This is very high. It's a very high market cap. But for a brief moment in time, at the current shares that exist, this is possible. I think you could see $1,000 a share for a market cap of $515 billion. Why? Well, we're going to get into the problems later, but the money exists. You can come up with the money. It's possible to see that come from somewhere, right? Now we come up to 10,000. At $10,000 a share, you have a market capitalization with no extra synthetic shares of $5.15 trillion. If this was a flash in the pan, right? If you were to briefly hit $5.15 trillion like here or here in total market capitalization, it would require the money to be put forth to make it reach that market cap for that brief moment in time. Meaning you would have to, at least for a moment, have had $5.15 trillion put forth into this stock to reach $10,000. Now you're starting to grasp a little bit, right? This is already larger than Tesla, than Apple, than Microsoft, Berkshire Hathaway. This is twice as big as Apple, twice as big as Microsoft, and about 5 times larger than Tesla. Quite a big market cap. $25 trillion. At this point, you get where this is going, right? You're already at half the net worth, half the market capitalization of the entire U.S. stock market at $100,000 a share, which you would have to have enough money to make happen, right? You would have 100% of the entire U.S. stock market put into a single stock. Tesla, Apple, Microsoft, Hulu, Zillow, anything that exists. Every single dollar, you've got all that in one stock. You see where I'm going with this, right? The money is hard to come by. You'd have to find it somewhere. So now we go to 100 million share synthetics and then 2x. You can see what happens. Things go up. At $100, $61.5 billion market cap. I think this is possible. I do. $1,000, $615 billion market cap. Difficult, but I think it's possible. 10K, you're losing me here. $6.15 trillion. Where are you going to get the money? We're going to talk about this later. 50K, $30 trillion. Where are you going to get the money? 100K, $61 trillion. Where are you going to get the money? At 2x the float, right? This is a hypothetical. $100, you have a $103 billion market capitalization. Possible. I think that's very possible. 1,000, $1.03 trillion. I think it'd be very, very difficult, but I think it's possible. 10K? No. 50K? No. 100K? No. This is based on the parameters that presently exist. If you were to have a lower overall free float, meaning there are less shares available to the market, for example, if it was a 100 million share float, this changes exponentially because what you're doing is taking out 80% minus 80% of all shares existing. So if you had 100 million shares that are circulating in the market and you multiply that by 1,000, that is a drastically different picture than presently exists. Drastically. And we're going to get into this as we continue on. But let me just calculate this out for you. If I take a calculator and you multiply 100 million times 1,000, 3 zeros, 3 zeros, 3 zeros, you get 100 billion. $100 billion market cap. That's so possible. That's actually really, really, really possible. And that would make $10,000 even almost likely. You could see that potentially. I mean, I'm not guaranteeing you anything. That'd be a $1 trillion market cap, but 100 billion is drastically different. This comes down to the shares that presently exist. Where would the money come from, right? So that brings me to the next thing, right? I want to talk about the problems and the arguments against the problems. Problems. Where does the money come from? This is a question that I presently have. And I've seen arguments, and I'm going to present these to you. Arguments against the problems, right? I don't want to be biased. I want to present myself with all the information possible. People would point to the derivatives market and the world money supply, right? So here's a graphic that I have. People would point out to you that if you were to take the world supply of money, you can see this right here. I grabbed this from, I believe it was this website right here. All the world's money supply, $35.2 trillion of easily accessible money. I see that my camera's frozen. I'm going to fix that quick. $35.2 trillion of easily accessible money, which is what you would need in this sort of situation, right? So if you had $35.2 trillion of easily accessible money, that takes care of part of the problem, right? However, you'd have to get all of the money from across the world because this is the world's easily accessible money and put it in one stock. It's not impossible, but I find it unlikely. And the way that these kind of go is along the lines, right? If the money, who pays? Right? We've got the money in derivatives. There's a $1 quadrillion market for derivatives. So the money exists, but those are derivatives. A lot of leverage, a lot of margin, a lot of this, a lot of that, a lot of synthetics, quote unquote, money. Because if you look at the US money supply, there's currently about $22 to $23 trillion that circulate. If the money happens, who pays? Now, I've seen this argument a million times. Al from Boston being probably the primary guy who argues that DTCC would fork this up. But he says this: the DTCC is insured for up to $70 trillion. Now, myself personally, I have spent a lot of time scrubbing the DTCC website for information on how and where he's coming up with the $70 trillion number. I have not found it. Never once. I've seen that they handle transactions of trillions and trillions and even quadrillions of dollars a year, but these are essentially the clearing, the handling of money. It doesn't mean that they always have it on their books. Right? If you had, for example, $70 trillion and you were to multiply or divide that out by 365 days, it's a whole different picture, right? You're handling billions of dollars a day instead of trillions. I mean, this is a drastically different look, and that does happen. The stock market does process buy and sell transactions of billions of dollars a day. It doesn't mean that money is coming from the same source. It's not just new money, right? It's a lot of money getting recirculated. I haven't seen this. The $70 trillion number outside... I just don't know where you're getting it from. You know, it doesn't make any sense to me. And if you were to go a step further, I've seen this in the super stonk, Reddit forum. You'll see this. This means that the value of the assets in this pool are likely to deteriorate significantly. We have had a few different estimates given, for which I can't find a reliable source, saying that the DTCC should have somewhere between 60 to 75 trillion in the pool at the moment. So let's do some napkin math. Let's pretend there are currently 300 million GameStop shares out there. Let's pretend also that the DTCC's pool is devalued by 50% and is now worth only $35 trillion. We'll add another $1 trillion that is paid by the assholes from steps 1 through 3 on the staircase. There are other people who would step into the picture here, essentially insurance counterparties that would get you back on, I don't know, $250,000 if you're on the wrong side of the trade here. He came up with $36 trillion, right? And this is all assuming that... And this is important. This is assuming, this is where I have a problem, that the DTCC will be willing to cover all of these expenses. If you were to think about car insurance, right, or medical insurance, how frequently do insurance companies actually pay the full amount on anything? Never. And we're talking about Wall Street. Think back on 2008. This is as beautiful an example as anything, right? In 2008, did retail investors get an insurance payout? No. Wall Street did. I mean, where else do we have to look? In 2021. And this is not me saying you won't see a run-up, because I think you will. I think this is a drastically different situation than back in January of 2021. In January of 2021, when GameStop hit $500, what happened? The buy button was stolen. The buy button was taken away. That's not insurance. That's a bailout for Wall Street. That happened at $500 for GameStop. 25 for AMC. Granted, we did go up to $72, right? And I still think, I do truly believe, and I mean it when I say this, that you have not seen the all-time high. I don't think you have. I don't think you get the accumulation that we have without having seen an all-time high. These people are not buying stock, both institutions and retail, with the belief that it's just going to go down. That's stupid. It makes no sense, right? But insurance isn't going to do it here. There's just no way. We've seen that. History would suggest otherwise, which brings me to this. If they can't pay, where's the money come from? To me, it's the Fed, right? I've seen the argument, the Fed will print the money. And let's just hypothesize, right? Let's say, we'll take the bare minimum here. We'll say that the Fed is just printing that $51.5 trillion. What happened when the Fed printed $16 trillion, which is 80% of current money supply, right? You could have the DTCC cover. I'll take the low end, right? I'll go with the conservative estimate. We'll say the DTCC's got $35 trillion in their books, and you wipe out $35 trillion from that 51.5, right? So 51 minus 35, you end up getting this number, 16 trill. Let's print off another 16 trillion, huh? I know my camera froze again. I will fix this right now. Let's print out another 16 trillion. What's going to happen? Well, all money in existence would have been printed basically in the last 2 years if it was to happen tomorrow. You know? That'd be $32 trillion printed in a matter of 2 years if it was to happen today. That would come out to basically 95 to 98% of all money ever. That's at just this. No synthetic shares. You make it worse. You add 100 million or you double it, which is possible. You get 61.5 or 103 trillion. What this leads me to, if the money is produced, which is possible, what happens to the economy? It would die. Now, nothing is absolutely impossible. Maybe clickbaity. Maybe to say 100K is statistically, mathematically impossible is wrong. It's very, very improbable. 0.00000000001% chance, right? But I want you guys to think about all of the fail-safes that would have to get run by to make that happen. And one of them is the cost of the United States economy. I want to show you something. Venezuela. Here is a side-by-side of currency in circulation for the United States and then for Venezuela. It looks kind of familiar. It's kind of scary, to be honest. Venezuela has gone through a period of hyperinflation due to a massive, massive amount of printing and increase in money supply within their country. Peaked out over here at 18,926%. Do I think that would happen in the United States? No. But do I think it's possible? To some extent. If you print enough money and you don't handle the situation properly, it could. It really could. People talk about hyperinflation as is with $16 trillion being printed and not being handled properly. Now let's just pretend you do it again. The DTCC pays out half, $35 trillion to make that $100,000 price target happen. And then the Fed prints out another $16 trillion, right? You're doubling the money supply up again. That would bring you from a total of 22 trillion to damn near 40, come out to $38 trillion, which is drastically higher, may I add, from just 2020 or 2010. But even just 2020, if you look back here, we were at just about 16 trillion. That would mean you 2x'd. You went from 16 trillion, a 200% increase, to $38 trillion. What is that going to do to inflation? You'd see hyperinflation. For an example, if you took 1/5 of 18,000% peak, we don't even go with the peak, right? Let's just go with here, 8,000%. We'll just take this tiny, tiny little peak right here at 8,000%, 8,000% inflation. You take 20% of that, right? What does that come out to? Be like 1,600%-ish. 1,600% inflation is a 16x on cost. If you're paying $4 for a gallon of gas, make that 64. If you're paying $3 for a gallon of milk, make it 48. If you go out for a nice Mexican dinner and it costs you $10 for a double Jack and Coke and $10 for a meal, that's a $20 meal. You multiply that by 16, guess what? Your party of one meal is going to cost you $320. You would watch the U.S. economy collapse. That would be, to me, the legitimate end of the United States as we know it. There's a cost to that much money being printed and a cost to what that would look like for us as average people. Now, I want to make something painfully clear. It sucks to say because it's not our fault, right? Did you create the problem that exists in the stock market? Did you have to deal with synthetics? Did you naked short sell a stock? Did you try to bankrupt a company? Did you maliciously intend on gaslighting retail investors? And were you the SEC that made fun of retail investors? And are you the one who doesn't put out information for people to learn? No. In this situation, retail investors are the victim. It's not your fault. Why do we have to deal with the repercussions of people above us actions? I don't know. That's the way that the United States has always been. Where I do think things are possible is expectation management. And I want to talk about this. This is my resolution. I do think there are disgusting price targets that are possible. $100 up to $1,000 to $2,000, I think is possible. If at no synthetics, if there was absolutely none, I think you could legitimately see a $1,000 to $2,000 price with current supply. If you had a double up food bucks on float, I think you could see 1,000, but it would be very, very difficult. If everything lines up perfect, I think you could. It's possible. Myself personally, I watch charts, and I know people hate me saying that. They really do, and I get it. But I just watch charts. I watch, hey, how do things line up and how do things compare to what we've seen in the past? And what I've seen in the past and what makes sense to me in my head is, hey, if you were to have the equivalent of the June run up again using fibs, you could see this run up to $272 because what happened is it ran up to the 4236, right? You take the peak of the January run up to the bottom of the January dip, you fib it out, and it ran pretty much perfect. So if it did it again, you could see $272. That is disgusting. From $12, I don't know what that comes out to, but that's thousands of percent gain on just stock alone. It's nasty. That's fantastic, right? And I think that's possible. I really do. And I think that if that was to happen, that is a realistically good expectation to have. That is a phenomenal amount of money you would generate. It really is, right? And I think higher is possible with two different things. Higher is possible if we are willing to accept hyperinflation. And that's not us. We're not making that decision. The government makes that decision. Institutions make that decision. The DTCC has to make that decision. That has to go by a lot of people to be allowed to happen. And we have to assume there's not going to be a bailout along the way. Most realistic, higher is possible if AMC buys back shares. If there were 100 million shares on the market, you could see this thing go considerably higher. I do believe that, right? But that's what this comes down to. If there's a closing sort of note that I have here, it's this. I know this is a long video. I know that some people aren't going to be happy, and that's okay. I accept that. But here's my closing note. I think AMC can hit some awesome numbers when the bear market ends. I think it is going to be a historical short squeeze. I do. I think the run to 72 had a lot of things that lined up. You had stimulus money, you had this, you had that, you had whatever. And now things are different. We're in a bear market. I get it. But when the bear market ends and you get rallies and shorts start closing positions, I think that there is an opportunity for this thing to do something historical. There is, right? But we have to manage expectations. Where does the money come from, right? That's the number one question here. Money doesn't come out of thin air. I mean, it kind of does. The Fed prints it, but there's repercussions to that. And you're seeing it happen right now. The repercussions to the Fed printing $16 trillion is what you're living through. The repercussions to the Fed printing $16 trillion is the reason that we are down right now. It's the reason that every stock is down right now. You know? It's a difficult thing. And it will come at the cost of a lot of things to see $100,000 a share. Is it possible? It is. Anything's possible, but so improbable. And I think as retail, we have to band together to talk about these things and manage expectations. And I don't mean like, hey, listen, you should give up. This is it, right? No. Math is math. The accumulation here is disgusting. The short interest on this is disgusting. People have proven basically that the statistical probability of there being synthetic shares in this stock are basically 100%. I mean, damn near 100%. I think that is true. I do. But beyond that, we have to manage expectation based on history and based on math. And that's what I have for this video. If you want to debate this, please feel free to drop a comment down below. I am going to read them. I am sure that some of you guys will feel some sort of way, but I sleep good knowing that if even a few people pick something from this, it's worth something to me. So you guys, I'll take it easy. I appreciate you tuning in. We'll be back tomorrow as usual for a live stream. I will talk about this live if you'd like to. Take it easy. Much love as always. Light taps and peace.